For most of the last century, every great economic era has been defined by our revolutionary technology. Railroads transformed transportation. Electricity changed industry. The internet connected the world. Today, artificial intelligence is becoming the transformative force. Investors everywhere are asking the same question. Are we witnessing the beginning of a new technological golden age? Or are we watching another financial bubble forming in real time? The answer is more complicated than most people realize. Throughout my career, I have studied economic cycles, debt cycles, market manias, and technological revolutions. What I have learned is that revolutionary technologies can be real while investment bubbles can exist at the same time. In fact, some of the biggest market bubbles in history were built around technologies that eventually changed the world. The challenge for investors, understanding the difference between a great technology and a great investment. Right now, no company represents the AI revolution more than Nvidia. A few years ago, Nvidia was primarily known among gamers and technology enthusiasts. Today, it sits at the center of one of the most important economic transformations of our time. The company's chips power many of the artificial intelligence systems that businesses, governments, and researchers depend on, and nearly all of them require enormous computing power. Revenue has exploded. Profits have surged. Investors have rewarded the company with one of the largest market valuations in history. On the surface, the story appears simple. AI is growing. Nvidia is supplying the tools. Therefore, Nvidia wins. But markets are rarely that simple. One of the most dangerous mistakes investors make is assuming that because a company is successful today, it will automatically remain successful forever. History teaches us the opposite. In every technological revolution, there are early leaders, unexpected challengers, and eventual winners that nobody predicted. During the internet boom of the late 1990s, investors believed certain companies would dominate forever. Some survived and became giants. Many disappeared completely. The future usually belongs not only to the companies with the best technology but also to those that adapt best to changing conditions. When expectations become too optimistic, even great companies can become risky investments. The excitement surrounding AI reminds many investors of previous periods of market enthusiasm. During the dot-com era, investors believed the internet would change everything. They were right. The internet did change everything. However, many internet stocks still collapsed because investors paid prices that assumed perfection. The lesson is important. A revolutionary technology does not guarantee that every investment connected to that technology will succeed. Sometimes investors become so focused on future possibilities that they stop paying attention to present realities. When expectations become disconnected from fundamentals, bubbles begin to form. This doesn't necessarily mean AI is a bubble. Artificial intelligence is already delivering real value. Businesses are increasing productivity. Researchers are accelerating scientific discoveries. Companies are automating tasks that once required large teams of employees. Unlike some previous technological fads, AI is producing measurable economic benefits today. The question is not whether AI is useful. The question is whether current market prices already reflect decades of future success. That distinction matters because investing is not about identifying good companies. It is about determining whether the market has correctly valued those companies. One of the most important principles in investing is understanding the relationship between price and value. Imagine owning a house worth $500,000. Someone offers to buy it for $5 million. That doesn't necessarily mean the house became more valuable overnight. It may simply mean expectations have become unrealistic. The same principle applies to stocks. Investors often confuse a rising stock price with increasing value. Sometimes value is increasing. Sometimes enthusiasm is increasing faster than value. The difference between those two scenarios can determine whether an investment generates exceptional returns or devastating losses. Another factor driving AI stock prices is fear of missing out. Human psychology plays an enormous role in financial markets. When investors see others becoming wealthy, they feel pressure to participate. Nobody wants to be left behind during a historic opportunity. This fear often causes people to abandon discipline. Instead of asking whether an investment makes sense, they ask whether everyone else is buying it. This behavior has repeated itself throughout history. It occurred during the railroad boom, the radio boom, the internet boom, the housing boom, and numerous other market manias. Technology changes. Human nature does not. The AI race is also creating enormous capital spending across the technology sector. Companies are investing hundreds of billions of dollars into data centers, chips, cloud infrastructure, and AI development. This spending supports growth for companies like Nvidia, but it also creates risks. Whenever large amounts of money flow into a single area of the economy, competition eventually increases. New entrants emerge. Margins come under pressure. Innovation accelerates. What appears to be a permanent advantage can become less certain over time. Investors should remember that extraordinary profitability often attracts extraordinary competition. Another issue investors often overlook is how rapidly technology evolves. Today's dominant technology can become tomorrow's outdated solution. Throughout history, technological leadership has rarely remained static. The companies that dominate one generation are not always the companies that dominate the next. This doesn't mean Nvidia will fail. It simply means investors should avoid assuming any company is invincible. Markets reward adaptability, not complacency. When discussing bubbles, it's important to understand that bubbles rarely burst because people suddenly realize a technology is worthless. Most bubbles burst because expectations become impossible to satisfy. Investors begin demanding perfection. Any sign of slowing growth becomes disappointing. Valuations leave no room for mistakes. Eventually, reality collides with expectations. Even strong companies can experience dramatic declines if investors had expected impossible outcomes, and those expectations can become dangerously optimistic. One reason AI has generated so much excitement is that its potential appears limitless. People imagine intelligent assistants, autonomous vehicles, medical breakthroughs, advanced robotics. Adoption can be uneven. Regulations can create obstacles. Competition can reduce profitability. The path from innovation to sustainable profits is rarely straightforward. There is also a broader economic context that investors must consider. We are living through a period of significant debt accumulation, geopolitical competition, and monetary uncertainty. Government debt levels remain elevated. Interest rates influence investment decisions. Global supply chains continue evolving. These factors affect financial markets regardless of technological progress. Even the most exciting companies operate within larger economic systems, concentrating too much wealth in a single theme. They believe they have identified the future and should invest accordingly. Diversification exists because uncertainty exists. Since the future is uncertain, suppose artificial intelligence continues growing rapidly over the next decade. That does not automatically mean every AI stock will outperform. Markets reward the best businesses, not necessarily every business associated with a popular trend. This distinction becomes especially important during periods of widespread optimism. The media also contributes to market enthusiasm. Headlines focus on extraordinary success stories. They celebrate dramatic gains. They highlight rising valuations. What receives less attention are the risks, failures, and uncertainties that accompany every investment opportunity. As investors, we must resist being influenced by headlines alone. Good investing requires independent analysis. It requires asking difficult questions even when everyone else appears confident. Another characteristic of bubbles is the belief that Traditional valuation methods no longer matter. Investors begin arguing that old rules no longer apply because the opportunity is unprecedented. History shows that this mindset often appears near market extremes. While technology evolves, economic principles remain remarkably consistent. Businesses ultimately generate value through profits, cash flow, and productive activity. Ignoring these fundamentals can lead investors into dangerous territory. At the same time, being overly skeptical can be equally costly. Many investors missed enormous opportunities because they dismissed transformational technologies too early. They underestimated the impact of personal computers, the internet, smartphones, and cloud computing. The goal is not to avoid innovation. The goal is to participate intelligently. Successful investors balance optimism with discipline. They recognize opportunities while respecting uncertainty. If I were evaluating investments today, I would focus on several key questions. First, does the company possess a sustainable competitive advantage? Second, are current valuations reasonable relative to future expectations? Third, how vulnerable is the business to competition? Fourth, what happens if growth slows? Finally, how does the investment fit within a diversified portfolio? These questions help investors move beyond excitement and toward rational decision-making. The future of artificial intelligence is likely to be extraordinary. Productivity could increase dramatically. New industries could emerge. Existing industries could be transformed. Economic growth could accelerate. These possibilities deserve serious attention. However, investors should remember that technological revolutions create both opportunities and risks. Success depends not only on identifying trends, but also on managing expectations. Throughout history, the biggest fortunes were often created by people who remained disciplined. When others became emotional, they recognized opportunities without abandoning risk management. They understood that uncertainty never disappears. They focused on probabilities rather than predictions. Most importantly, they avoided confusing excitement with investment wisdom. So, is Nvidia a bubble? Are AI stocks overvalued? The honest answer is that nobody knows with certainty. What we do know is that artificial intelligence is reshaping the global economy. We know that investor enthusiasm is extremely high. We know that expectations have risen dramatically, and we know that history teaches valuable lessons about how markets behave during periods of technological transformation. The smartest approach is neither blind optimism nor blind pessimism. It is thoughtful analysis. It is understanding that revolutionary technologies can create extraordinary wealth while still producing painful market corrections. It is recognizing that great companies can be poor investments if purchased at unreasonable prices. And it is remembering that long-term success comes not from predicting the future perfectly, but from building portfolios that can survive a wide range of outcomes. In the years ahead, artificial intelligence may become one of the most important innovations in human history. But as investors, our job is not simply to identify innovation. Our job is to determine how much that innovation is worth, what risks accompany it, and whether the price being paid today makes sense. Those who understand that distinction will be far better prepared for whatever comes next, whether AI becomes the greatest investment opportunity of this generation or the source of another painful market correction. One thing is certain: the decisions investors make today will shape their financial future for years to come.